So Mastering Tax Essentials, a guide for bookkeepers. Now I have a CPA practice that I've been in business for 15 years. Actually, this year is my 15-year anniversary. And like I said, it is 15 years of experience, but I don't know it all because our tax laws are constantly changing. But my passion is helping my clients with tax advisory and also tax preparation, because advisory is where we can meet throughout the year and just talk about what's going on with their books, what's going on with their financial situation, so that we can come up with some tax strategies to help them before the year ends. But my true passion is knowledge sharing. And so that's how I'm going to come into this session, and with every session that I do is let's learn together. The agenda today, we're going to go over tax basics. You know, it's not for you to become a tax expert, but let's at least get to know those tax concepts so that when you're doing the books for your clients, you start to identify those tax themes and those tax issues that might arise, and you're just in time before the year closes to help that client out. And then we're going to go into financial statements, right? That's what you're familiar with. And how does financial statements tie into the tax? Because in order to prepare the tax return, we're going to need those books. We're going to need those financial statements to be on par and to be reconciled and ready. And how do we get those ready for tax time? And at the end, we're going to open it up for questions, right? This is a learning session. Bring your questions. If you can't think of any questions, I will provide my contact information at the end. Maybe you come up with more questions at the end. I'd be happy to answer any questions that you have. But with that, let's dive into tax basics. And we're going to bring it to the very minimal personal income tax. So let's step aside from business income tax. Let's talk about just you and I, our personal income tax and what this is. If we start off at the very top, what are taxes? Well, unfortunately, those are mandatory contributions that have to get paid to the government. And they're levied on different types of things, either income, property, or sales tax, right? Those are the three most common taxes if we look at a world of taxes. And so what does the government do with this money? You know, they're supposed to allocate it to provide us with public services, public education, the infrastructure of our country, or even state income tax for the state that we live in. Now, I will tell you, I live in Texas. We don't have state income tax. I don't know where everybody is from, if they are subject to a state income tax. But here in Texas, we are not, but they sure make up for it in our property taxes. Those are really high. So what income is taxed? We're going to concentrate only on federal income tax for this session and only on income tax. So what type of income is taxed? Unfortunately, all income. That is our general rule. If we were to look at the Internal Revenue Code, the tax law, it does say all income is taxed. You find some money on the floor, guess what? It's taxed. But you know what? The great thing about the tax code is that once you start reading it, there are exceptions to this rule. And that's what it says. Generally, all income is taxed unless there is a law that is written where it could be exempt, it could be deducted, there's some kind of adjustment. And so yes, it's a big world of taxes, but the general rule, just know, generally it will be taxed. And so how to report this tax, this income tax, on tax forms. And that's what we file every year with the government. If we look at income, we're going to talk terms. You know, what are these terms that are talked about when it comes to income? If we separate our income into two separate buckets, we have what's called earned income, which is what it says. You know, you're earning this income, you're doing something, blood, sweat, and tears to earn this type of income. And then we also have investment income. You're not really doing much to earn this income. And they call it most likely pillow income because that money is working for you and you're not working to earn that money. And you know what? These two type of buckets, they're taxed very differently. The earned income is subject to ordinary tax rates. That's a term that you'll hear. And those tax brackets are as low as 10% up to the highest tax bracket, which is 37%. And then if we look at our investment income, so that has a mix of a lot of things. Investment income. Some of that investment income could be subject to ordinary tax rates, which is what we just said, the 10% up to 37%, or it could be subject also to capital gains tax rate, which goes from 0%, which is amazing, up to 20%. And if you take all of your investment income, and as a single person, if you're making more than $200,000, that investment income is subject to a separate income tax, which is called the net investment income tax. And that started in 2013. But that's a problem that you have to worry about if at least you're making $200,000 and you have investment income. So now let's define the difference between what is earned income. Here are some examples, right? Wages, salaries, business income, self-employment income. That is what's called earned income because it's blood, sweat, and tears to earn that income. Investment income. The most common investment income that we can think about is that money that you put into a savings account and it's earning interest. You're not doing nothing other than depositing some money in there and it's gaining interest income. That's an example of investment income. So once we have all of our income gathered, the law allows us to make adjustments to that income. And those adjustments can be positive or negative. Here are the examples of the most common negative adjustments. What that means is that it's going to lower our chunk of investment income and earned income. So some of the most common investment or adjustments to that income, educator expenses. That's available for teachers. If they spend money on classroom supplies, they are limited to the amount, but they are allowed a deduction. We also have self-employment tax because when we have our own self-employment income, we are subject to self-employment tax, but we get an adjustment for that. The government allows us to deduct some of that tax and reduce it from our income. So once we reduce our income down to these adjustments, we reduce them by these adjustments, we come across what's called adjusted gross income. But we don't stop there. There's laws that allow us further deductions. So if we look at those further deductions, we have the standard deduction or itemized deductions. It's either or. You can't take both. So the standard deduction or the itemized deduction, you take the one that's greater. Standard deduction, what is that? Just like the name says, it's really the name that the IRS has put on there, and it's an amount that the government has figured out for us of what they think is what our living expenses are. They call it a standard deduction, and every year it increases due to inflation. But then you also have itemized deductions. Now in that bucket, what can you put in there? You can put medical expenses. Now those are very limited, so it's not like you're going to get a dollar for dollar deduction on everything that you spend for medical expenses. You have to jump through some hoops in order to benefit from any medical expenses. So medical expenses goes in the itemized deduction bucket, real estate taxes, state income taxes that you're paying, mortgage interest, charitable contributions. And then you compare both buckets. Whichever is greater, that's the deduction that you're allowed to take from adjusted gross income, or AGI as it's known. And then after that, we have another deduction that is allowed to us, which is called qualified business income deduction. But you must have a business to be able to benefit from this type of deduction. Then we come across tax credits. Tax credits are divided into two. We have non-refundable credits, which what that means is that the credit that you receive cannot go over the tax that you owe the government. You won't get a refund for anything over. You only get to use that credit up to the amount of the tax that you owe. And then we have refundable credits. Those are the nice ones because that's actually the government paying you extra if you have all of your tax paid off through the credits. That refundable credit, the extra, will be able to get refunded back to you. So all of this that I've said, I like to depict this in an illustration, like a roadmap, like a journey of what our tax return looks like. Now remember, this is only our Form 1040, which is our personal income tax return. There's a lot of adjustments, deductions. It's better if we look at this and we follow it through a roadmap. And we start off at the very top. Like I said, what income is taxed? General rule, all of our income is taxed. We start off accumulating all of that income, employment income, business income, investment income, other income. And that's what the IRS has on their form. Basically saying if there's not a line item for that income and that you can accommodate here, for example, finding money on the floor and you put it on your tax return because you have to, that would be as other income. So really what they're saying is all income is taxable. That's how we're going to start off with the Form 1040 at the very top. Start off with gathering all of that income. And then the next step, well, we call that gross income. From there, then let's go into our adjustments. What does the tax law allow us to deduct from the total gross income? that is reported on what we call Schedule 1. From there, we arrive to our adjusted gross income, or AGI, and we go further into more deductions. Those are reported on Schedule A and Form 8995. Those are the types of standard deduction or itemized deduction and the qualified business income deduction, which is your QBI. Now that is what makes you arrive to taxable income. Taxable income is what is run through the tax tables with the IRS, and there's several tax tables because it all depends on how much you make and how you're filing your tax return. Are you single? Are you married filing joint? From there, once you figure out what the tax due on that taxable income, you multiply times your tax rate. From there, you're still not done with your tax return. Now, I will tell you, if you've looked at a 1040, it's not as easy as just 3 or 4 lines. You arrive to what you think the amount of your tax liability is. But wait, we have refundable and we also have non-refundable credits. At this point, we deal first with the non-refundable credits. After you make those adjustments for your non-refundable credits, then we arrive to the true tax liability. But another thing, now let's deal with refundable credits. So we have a tax liability to the IRS, and here's where we reconcile with them. Are there any refundable credits that we are allowed? The most popular, the earned income tax credit. So you might have a very small tax liability, but you are entitled to a pretty large earned income tax credit. That's a refundable credit. Guess what? You're going to get a refund from the IRS because you have more refundable credits than you had tax liability. But at this point, we also reconcile, hey, IRS, I've paid in maybe through a W-2. My employer has been taking taxes away every paycheck. I've paid in throughout the year. So this is a time you reconcile. Not only do I have refundable credits, but I also have some withholdings that I sent in throughout the year. And then at the end is where we reconcile with the government. Did we pay enough for the government? Did we pay in too much? We get a refund. Did we not pay enough? Then we have to write a check to the IRS. So that's the journey in a quick way to illustrate the Form 1040 personal income tax. Now let's move into business income tax, because there's different types of entities for your business income tax. And we're going to go over the most popular, right? The sole proprietorship. Now, if you can see, a sole proprietorship business is reported on a schedule. Schedule C, Schedule E, or F. Schedule C, the most common one, it's a business. Schedule E is rental income. Schedule F is farm income. If you have a farm, you're working the farm, that's where you would report those schedules. You can notice that they're called schedules because they are attached to your personal income tax return Form 1040. So a sole proprietorship, it's the most easiest way to start a business. You just really have to have the intent that you want to start a business. You start producing that income, start making those expenses to produce that income for your business. And you report that on your Schedule C. Now, if you have heard of limited liability companies, LLCs, now that's a step above. A sole proprietorship is not incorporated. You just started a business, you just start getting income expenses. An LLC, that's a way to structure that business and protect it because it provides more of that legal liability protection for your assets. Now, what I do, I advise my clients to do an LLC, especially if my client owns a home, has some personal assets of their own. The LLC would protect them, that if they were to ever get sued, their business were to get sued, they can only come after the business assets to collect on. They can't touch the home, they can't touch any personal assets. So definitely I recommend having an LLC to protect those assets. We're talking about LLCs. LLCs is what I highly recommend my clients to do, an LLC for protection. So when you're an LLC, this is where you have to make a decision. Are you a sole member LLC, meaning just you own it and you don't have partners? What about if you're married? Then you can also be considered a disregarded LLC, depending on the state that you live in. I live in Texas, it's a community property state, so my husband and I have a business together, but we are considered a disregarded entity according to the IRS. Because that's all I've told the IRS. I haven't told them I want to be taxed as an S corp, as a partnership, or anything else. So according to the IRS, since I have not communicated anything to them, they are considering me to be a disregarded entity, and they expect from me a Schedule C on my personal income tax return. So yes, the LLC, definitely highly recommended. LLCs that are reported on a Schedule C, like we know, most likely they're going to be a calendar year. It's the easiest on a Schedule C. But all profits on a Schedule C are subject to self-employment tax. And that is on top of the income tax. And that's one of the things that I explain to my clients. I say, when you have your own business, just know that you're subject to 3 different taxes. And this applies to everyone, even if you're with an employer and you get your W-2. On our earned income, we all have to pay 3 different taxes. Our ordinary income tax, we have to pay our Medicare tax, and we have to pay our Social Security tax. Medicare and Social Security tax, you bring those together, 15.3%. The great thing about being an employee is that your employer company is the one paying half of that payroll tax, the Medicare and the Social Security tax. But when you are self-employed, you have to pay for 100%, both sides, 15.3% in total of that self-employment tax. If you remember, we looked at adjustments to gross income. One of the adjustments is that the IRS does allow us to be able to deduct half of that self-employment tax to reduce our income. So now if we look at a corporation, okay, so now we're moving into the LLC has elected, either the LLC or a company that just formed, they have elected with the IRS that they are a corporation. And what that means is that they didn't let the IRS know that they are not disregarded. They're just a corporation. They have not elected for S corporation status. So the corporation, it's not as popular. The reason is because there's double taxation on the income. For a corporation, the corporation has to file a tax return, the Form 1120, where they take their income minus the expenses, and the profit that's left over gets taxed at a flat rate of 21%. That profit that's left over, the corporation can decide to give it back to the shareholder owner as a dividend. The shareholder owner turns around and puts that on their tax return as investment income. And that is subject to either their ordinary rates or either could be capital gain rates. But yes, so it's double tax. That net income for a corporation, double taxation. One of the downfalls about a corporation, but one of the great things that has happened so far, starting in 2017, is the low rate of 21%. Before that, it was pretty high. That is set to expire in the year 2025. If TCJA, which is our Tax Cuts and Jobs Act, doesn't get extended, the corporate tax rate might go up. But there's talks out there on whether who wins the presidency that there's plans of bringing that 21% even lower. So we'll see what happens. But if we look at the tax flow on the Form 1120, like I said, you take your income minus your deductions, which are your business expenses for the corporation, brings you your taxable income, tax rate, flat percent, 21%. And then you get some payments and credits if you've made some estimated payments for that corporation. And then you square it up with the IRS. How much of a refund do they owe you, or how much of a balance you owe them? But let's talk about pass-through entities. Pass-through, the benefit is it is not double taxed. They still have to file a separate tax return, whether it be an 1120S for S corporations or a 1065 for partnerships. But what they're going to do is it's really just a report to the IRS of, hey, this is how much money came in, these are how much my expenses were, but here's my net profit, and I'm going to pass it down over to the owners of this company. I'm just filing a Form 1120S or a 1065 with the IRS to report all of that. No tax due on those forms. And like I said, S corporation, for looking about terms, the owner of an S corporation is a shareholder. There has to be reasonable compensation and an accountable plan, and I'll go over that in a few more slides. So if we look first at just the 1120S, the S corporation, an S election must be filed. So let's assume you do have an LLC. Maybe it was created 10 years ago, but now you're thinking about making this LLC to be taxed no longer as a Schedule C because you don't want to be taxed on that self-employment tax, but now you make a business decision of this income on the Schedule C, it's really high. I'm really profiting a lot of money that I'm going to go ahead and elect to be an S corporation. You can do that, whether you're in year 1 of your business, year 10 of your business. But all you have to do is file that S election with the IRS no later than 2.5 months of the beginning of your calendar year or your fiscal year. Now, there is such a thing as late elections. We won't go over that, but just know that usually the general rule is 2 months and 15 days after the beginning of the year, you have to make that election. But then also comes reasonable compensation. The IRS is expecting that the shareholder owner is going to receive a W-2. When you're an S corporation, they're very strict on getting a W-2 issued to that shareholder owner. So it is a little bit more work when you're an S corporation, but it comes to a point where it makes sense. It makes sense to pay these administrative costs to be an S corporation versus being a Schedule C sole proprietor. Then you have the one thing that they call accountable plan. What accountable plan is when you are a shareholder owner of your S corporation and you accidentally used your personal debit card or your personal credit card to pay for an expense of the company. Hey, you know what? You're going to submit that reimbursement, that account according to your accountable plan rules. Submit that reimbursement to your company to get your money back. Or maybe you're using your personal vehicle to drive and have those business miles strictly for the S corporation, but it's your personal vehicle. Hey, you know what? Submit that expense report with your S corporation. And also look into those rules because the IRS is very strict about accountable plans. It's usually like a 45-day reimbursement plan. They're strict. You can't just wait until the end of the year to reimburse yourself for those expenses that you have been paying out of pocket related to your S corporation. And then that profit and loss that comes from the S corporation, it flows down to the shareholder owner. And they turn around and report that on their Form 1040. So it's only going to get taxed once. Bases, that's at the very end. Now that's it has to be a whole hour class just to talk about bases and how important it is to track bases. What that is the shareholder owner, how much investment, how much money, capital that they bring into the company to start the company, or even throughout the year. Maybe the company was wanting to invest in something or spend the money and there was no funds. Well, you know what? The shareholder is going to write them a check, write the S corporation a check to invest in money. So you got to keep track of that. How much money has this shareholder paid into the company? Because the day that the S corporation generates a loss, at that point, we need to make sure, do we have enough basis to take this loss on our tax return? Actually, 2 years ago, the IRS came out with Form 7203, which is to track your basis as a shareholder. And there's rumors that coming in the next year or so, there's going to be an official form to track basis for a partnership as well. There is not one right now, but there are rumors that that's going to probably come into play too, because the IRS does not mess around with basis tracking. They don't want everybody taking a loss on their businesses unless they have enough basis to take that loss. So the partnership, just remember this, partners are not employees. Yes, they might be working for their business, for their partnership, but we cannot issue them a W-2. They are not employees of the partnership, of the business. Instead, if they are providing services to the partnership, then they would be paid according to the partnership agreement, some kind of guaranteed payment is what it's called, but not a W-2. And then in the partnership, you can have different types of partnership. Is it a general partnership? Is it a limited partnership? Just know general partners are the ones that usually have all of the liability for this partnership. Whether the partnership is doing some fraud transactions, the general partner, whoever is that general partner, is 110% liable. But they also might get guaranteed payments for their services. So yeah, there is no kind of protection from the IRS if you are a general partner. And so the expenses, what about if the partner uses their personal card on accident or maybe drives the business miles on their personal car? We talked about an S corporation, how they have an accountable plan. For a partnership, it could also be an accountable plan, or it could be an unreimbursed partner expense. And that's usually reconciled at the end of the year on the partner's return on their Form 1040 when they say, this is how much I got from the partnership as income, flow through income, and these are my expenses related to that. And then the net is what gets taxed on the tax return. Again, there's a reminder at the bottom, like I said, basis. Keep track of that basis. If you have any clients that you're preparing tax returns for a partnership or an S corporation and there has never been a basis tracking, do it now. It's better late to do it now and go back in time and start recreating those basis schedules before the IRS comes asking for those. And here's just the flow through of the partnership return or the S corporation return. You really have income minus business expenses is your ordinary business income that gets reported on a Schedule K-1 to the partner or to the shareholder. And that's what they're going to use to prepare their personal income tax return. On the K-1, you will see also what we call separately stated items. So what are separately stated items? Those are items that could be taxed at different rates depending on who you are as an individual. And that's why the IRS says you need to not include those up here as part of your income and deductions. Do not include them as income. Do not include them as an expense. Instead, include them separately as a separately stated item. One example, capital gains. Remember I gave you the range that it could be taxed at 0% or 20%? Well, it all depends on you individually. Where are you on your income tax bracket? You know, it all gets taxed differently depending on who you are. So that's why those kind of separately stated items still get reported, not included in net income or profit, but separately stated on the K-1. Okay, so now if we go into financial statements, right? And you're familiar with these financial statements. These are the most common reports that you would run from your accounting software. As a tax preparer, if I did not prepare the bookkeeping for the client, then I will be asking for the income statement, the balance sheet, and the general ledger. The general ledger is the one that reports every single daily transaction for that client for the year. And the reason is just because I'm going through it, I have to do my due diligence to prepare the tax return. And you know, when I partner up with a bookkeeper, we're working together. There might be things on the general ledger that I notice that I have more questions on, and the bookkeeper, responds to my questions, and we work together. It is never of me trying to correct anybody or the bookkeeper trying to correct me. It's really that one relationship that I really cherish because we're working together for our client. But the income statement or profit and loss statement is also known as that name. It is very necessary for all of your business tax returns, whether it be a sole proprietor, Schedule C, an 1120S, S corporation, partnership, corporation. You need that profit and loss statement. And here are the components. And I'll leave this for you to read later, but these are basically the components that would come on a profit and loss statement. But getting that profit and loss statement, that income statement ready for the tax return, these are the things that I look out for, is the revenue. We need to make sure that all revenue is recorded. Whether it was cash deposits, we need to ask the questions. Client, was this a contribution? Or was this maybe income that you received separately and you're depositing the cash? All revenue must be declared. Back to the general rule. All income must be reported. Your cost of goods sold, make sure that we have those separate, depending on the industry that the client is in, right? That they spend some money to produce a certain good that they are selling. If they did, then let's keep those separately as cost of goods sold. Maybe they paid in contractors or they purchased inventory. Let's keep those separately from our regular operating expenses. And our operating expenses. To me, one of the very helpful things is doing officer compensation separately from your wages. So what that means, you have a business entity and you're paying W-2 wages to your employees, but you're also paying yourself. Remember, we talked about the S corporation. You have to have that reasonable compensation paid to the shareholder owner. If we could please separate those on the profit and loss statement, the income statement, that would be very helpful. Because I have seen books that come to me where it's just one line item that says W-2 wages, salaries, and it matches the W-3, right? The sum of all of those W-2s. It matches, but I always have to come back and ask, well, how much was just the officer compensation? The reason is because that gets reported separately on the S corporation return. Also, always separate your business meals. Business meals have a different deduction for books versus tax. Tax law, as of today, only allows a 50% deduction on business meals. So as a tax preparer, when I look at books, I love to see business meals separately stated because I know just grab that number times 50%, that's what should be deducted on the tax return. Entertainment expenses, also keep that separately. Now, entertainment expenses, depending if you're preparing your books based on preparing a tax return or you're really keeping your books as true income and expenses that the business incurred, because entertainment expenses might be deductible according to the general accounting principles, but it's not deductible for tax. The IRS will not allow you to deduct any entertainment expenses. So I want those separately. If you are keeping track of those on your income statement, on your profit and loss statement, at least have a line item that calls that out. Because what I'm going to do is turn around and tell the client these were not deductible. FYI, you won't see a deduction for entertainment expenses on your tax return. Vehicle expenses, yes, keep those separately, especially if the company owns vehicles that are under the business name, or how about if the client is using their own personal vehicle for business miles? That would be separate, but that would be included within your vehicle expenses. I would like a line item that says business mileage reimbursed to the owner. And then capital expenses. So what that is, if the client has purchased assets, big equipment, we need to know the difference whether can we deduct this asset in year one, or does this have to go on the balance sheet as an asset? And it all depends on their capitalization policy, and I'll go over that in the next slide for balance sheet. When I'm talking about non-deductible tax expenses, so if you are preparing your books for the tax return, you need to get them tax ready. Whether you're preparing the return or you're partnering with someone, these are the most common non-deductible tax expenses that would be helpful to be a line item on the profit and loss statement if that's where you're going to keep them. Also, having that conversation with your client. Even if you're just preparing the bookkeeping for your client, it's really important to tell them about these expenses. One, maybe they're spending money on lobbying expenses. You know what? That's not deductible. Do you really still want to invest money on lobbying expenses? It's not deductible for tax purposes. Like I said, entertainment expenses. So these are most of the non-deductible. The number one hit, personal expenses. And that's a talk that we need to have with our clients. If we start seeing a lot of personal expenses made through the business account, that could really compromise that protection liability that they had, because they either incorporated, created a limited liability company to protect their assets. Well, you know what? When you mingle transactions and you use your business card to pay for personal expenses, that could really compromise that liability to where a judge in a courtroom can remove your liability and all of your personal assets are now being pierced and can be subject to the collection of a suit. So yes, we need to have that conversation with our client to not run the business card, please, to do personal expenses. Well, but what about if they do, right? We see we can't go back in time, but we are noticing that they're using their they're paying their personal expenses with the business card. One, don't record it on the books as an expense because it's not a deductible expense. It's a personal expense. Instead, we need to classify them and send them over to the balance sheet because these are either owner distributions, if you're a sole proprietor. If you have the books for an LLC, if that sole proprietor has incorporated as an LLC, then you're going to name those as member draws. If it's a partnership, their partner withdrawals, or an S corporation, it's a shareholder distribution. Those are distributions. And you know what distributions do? They reduce the basis, which can compromise. Remember, you need to have enough basis to be able to deduct a loss from a flow-through entity, from a pass-through entity. So here's our balance sheet. It's 110% necessary to have a balance sheet for a corporation, a S corporation, or a partnership. Now, there are things on the tax returns that are not, there's a schedule for a balance sheet and it's not always required. However, it's amazing to have. The reason, it might not be required to be reported on the tax return, but the IRS comes knocking for an audit, the first thing they're going to do is ask for a balance sheet. So we might just have our balance sheet on file ready for any type of audit or questioning. Sole proprietors, There's no such thing as a balance sheet for a sole proprietor. Nowhere on the tax return for a Schedule C do you have to report a balance sheet, but it is a great idea as well. Not only for an audit, if an audit were to ever come, but also if this business client of ours that has a Schedule C is thinking about incorporating, is thinking about growing, is thinking about one day selling their business, they're going to come, the buyer is going to come and ask for financial statements, including a balance sheet. So the balance sheet components, right? You have assets minus liabilities, that's your equity. Your assets, you have to make sure that you separate them, whether they're current year assets, meaning that they are within a year, or they're long-term assets. Liability is the same, short-term or long-term. And your equity, this is where either the company keeps the profit for themselves, doesn't make any distributions out, and they just keep reinvesting that profit into the company, or they distribute it out to the partner or the shareholder. Tax ready. So when you're getting ready to prepare that tax return or partner with the tax preparer, what happens to your balance sheet? What's important to know? Bank reconciliations is a must. When I don't prepare the books for my client and I partner with the bookkeeper, that's the question I ask. Have the accounts been reconciled? I don't need to see the reconciliation reports, but just as long as there's clarification that those bank accounts, credit card accounts, everything has been reconciled. The capitalization policy, what I mentioned earlier, you have a client who purchased an equipment or maybe a laptop. Well, there has to be in place a capitalization policy, because what the IRS says is, hey, this is an asset that has a life longer than 1 year. So by default, you have to depreciate this asset, meaning you cannot take 100% of that asset's expense, that asset's cost, on year one. Instead, you got to spread it over the life of that asset. However, having a capitalization policy, and I included a link to the IRS's notice on what to include in the drafted capitalization policy, is basically telling the IRS, you know what, as a company, we came together, even if you're a sole owner, and my limit is if I buy any kind of asset, any kind of equipment under $1,000, then I can expense it in year one as an operating expense. If it's over $1,000, then okay, I agree, IRS, I'm going to capitalize it, I'm going to extend it throughout the life of that asset. The limit is $2,500 per the IRS. So you can have a capitalization policy in line and just put on there that your max is $2,500. Anything bought under $2,500, expense it on year one. Anything over $2,500, you're going to have to depreciate it over the life of that asset. A long-term asset and a long-term liability. What I have seen this is where the company makes a loan and lets the shareholder owner or the partner owner borrow some money, right? It has money and it's like, you know what, I'm not going to give you a distribution, but you needing some money, I'm going to write a loan to you. I'm going to give you a loan. Or the other way around. Maybe the partner shareholder doesn't want to contribute, any more money into it. Instead of saying, I'm going to give a loan to my company, which is totally acceptable. However, it needs to be a bona fide loan per the IRS. And what does that mean? There has to be a written agreement between the shareholder owner and the company. There has to be a stated interest rate. And so I included here a link for the applicable federal rates. It doesn't have to be a 20% rate, but at least has to meet the minimum applicable federal rate. And it has to be signed. Keep that for your records. Because what can happen is that if there is no loan document on file, the IRS can come back and say, that's not really a loan. It was a distribution, or it was a contribution to equity. And if it was a distribution, was that distribution taxable? I don't know. Do you have enough basis? That's why I say basis is super important. So yes, keeping track of these capitalization policies on file, the bona fide loan agreement on file is important. Like I said, bookkeeping and tax preparation come hand in hand, because we have the same goal, is to keep our clients in line, not only with compliance to be with the IRS, compliancy with the state agencies. At the end, us, even as business owners, we know how important financial success is. We have our own business because we are trying to achieve that financial success for ourselves and having that legacy down to our kids. So yes, it's really important. Let's collaborate, find a preparer that you can collaborate with, and you can teach each other. Like I said, we don't know everything, but we can learn together. So with that, I'm going to open it up for questions. But here is my contact information. If there's no questions that you have now, but maybe later you want to connect, I am open to connecting with anybody. I like to collaborate, share the knowledge. But I do have a newsletter here too that you can subscribe to my newsletter, where I'm going to have upcoming courses. I'm going to have tips and tricks for you guys. It's a free newsletter, so feel free to subscribe whenever you can.